This is business valuations. What are they and when are they needed? Um, this is going to be a really 30,000 foot overview of what to look for and what to listen for when talking to your clients or anyone for that matter for the potential need for a valuation. So I'm Scott Bundy. I'm a CPA and ABV. Will Dagli. I think he might be the newest CPA in Virginia. I don't know. Probably the newest
Yeah,
one at Hantzmon.
definitely a Hantzmon, but
Uh, which is awesome. So, what is a business valuation? A business valuation is a calculation of the fair market value of an ownership interest in a company or an asset on a specified date. And specified date is very important when it comes to valuations because we are, as the valuation analyst, we are kind of hamstrung by the specific date. Uh, and I can give you an example. I was working on a valuation for an estate, and the gentleman passed away, unfortunately, on February 20th of 2020. Naturally, everyone in the world knows what happened around that time, but the consensus of all the experts and all the databases that we used was COVID was not affecting the market until February 24th. So we could not take COVID's effect on the valuation of the actual company because it was after the date of the actual valuation. It's usually good, usually bad, but this on this specific occurrence was pretty bad for the valuation. The fair market value is defined as the price at which property would change hands between a willing buyer and willing seller when neither has a compulsion to buy or sell and both parties have reasonable knowledge of relevant facts. You know, to expound on that a little bit, that's just two unrelated parties. Neither has to buy, neither has to sell, and they both know all the information going into it. The main revenue ruling that started valuations is Rev Ruling 5960, issued in 1959. It provides the guidance of how to calculate fair market value and the factors to consider, I believe specifically to estate assets, but it's only 7 pages long. I don't read it nearly often enough, but read it every now and then as someone that does this fair amount. Fair market value. So the value of a business is equal to the present worth of the future benefits of ownership. For example, if I'm buying a company, I'm buying the future benefit stream or cash flow of that asset that it will produce, not what it has achieved in the past. What is the purpose of a business valuation? So the purpose of business valuation, again, beating the horse, but is to determine the fair market value of a business or ownership interest as of a specific date for a variety of reasons, including estate, gift, and income tax reporting and compliance. That's the main one that the main purpose for our business valuation engagements. Mergers and acquisitions, employee stock ownership plans, divorce and damages litigation, and charitable contributions. Now, this isn't a all-inclusive list. These are just examples. Obviously, estate and gift compliance is the main reason for our business valuation engagements, but we also do some ESOPs and whatnot like that. And jumping right into the code words, first code word is conference. While I'm waiting for y'all to write that down, does anybody have a question so far? Okay. Next one. There are different, a valuation report has different levels. And it is determined by their use. So the normal valuations performed by Hantzmon are a detailed or summary report. That's two different reports. They are both considered full valuations. Obviously, a detailed report is more detailed than a summary report. In my experience, the summary reports are about 80 to 100 pages long, including exhibits. The calculation report is a little less inclusive of detail than obviously the full valuation reports, and the oral report, which is simply telling someone over the phone, excuse me, or calling them or face to face of what the number is that we've calculated. There are so obviously there are some requirements for when a full valuation report is needed and necessary. And anytime discounts are included in the calculation of value, that is included in a gift or decedent's estate, a full valuation report must be included with that respective return. So, excuse me, if there is a gift of business interest, like gift of 1% or 10%, and discounts are taken, a full valuation report is required to be attached to that compliance return, that gift tax return, and the same as a decedent's estate, Form 706. Also, most litigation engagements normally require full valuation reports. I'm not sure how much litigation we work on at HW. I in the past have worked on a fair amount, but we're pretty litigious in Texas apparently. So we might not sue each other as much in Virginia. I don't know. So I'm gonna hand her over to Will.
Yeah, can we pop back one slide real quick? I just wanted to add one more helpful point. So the full valuation, that report, I guess one distinction that I think was helpful to me when I was learning about these reports is that full valuation reports are designed to stand up on their own in court. So they contain all of the materials necessary. So theoretically, no one on the valuation team needs to show up in court. That report should stand up to the IRS for whatever tax or estate valuation, and should just be a standalone document.
Yeah, that's a good point that Will just made. Thank you very much.
All right. So we felt that it would be helpful to take a look at the three primary, well, really just the whole process in general of how we come to the value conclusion and evaluation. So I'll be going over the three primary methods and a little bit about the discounts that are taken when we do evaluation. The three main approaches are the asset approach, the income approach, and the market approach. Evaluation standards say that we have to consider all of them, although you'll shortly see that some are considered more than others. So the asset approach is probably the most straightforward of the approaches when doing a valuation. It's fairly simply just the market value of the assets, and that less the market value of the liabilities, and your remaining equity balance is going to be the value calculated. The important things to remember in this are that the adjusted net book value method is the most commonly used of the two asset approaches. So under this method, we make adjustments to the asset values. The most common adjustments that are going to be made are going to be to property value. Frequently, appraisal reports are used, and we'll have a real estate appraisal or we might use the tax assessed land value done by the government or municipality. So the base values will be adjusted. The other common adjustments will be if a company is failing, they might have inventory that's obsolete, so we might have to look into changing the value of that inventory or writing off unrealizable receivables. The liquidation value method is essentially the same method, but we think about it from a standpoint of them needing to, or they're going to have to liquidate in a set period of time and won't be able to necessarily achieve optimal market value out of their assets. The primary time that the asset approach gets used, in my experience, is when we're dealing with real estate holding companies. Oftentimes, the fair market value of the asset is the market value of the real estate being held is a reasonable representation of the future benefits that those assets will provide. For example, if you have a rental property, the calculated an appraiser's value is going to look at potential future cash flows off of that rental property, and so it can provide a reasonable value for that property. The other time the asset approach is used is when we don't have positive cash flows or we're having a net loss in historical years and don't expect to turn the corner and produce positive cash flows. At which point, negative cash flows aren't going to allow us to use either of the two following methods. Scott, you want to move on to the next method? So there are two methods with the income approach. The first of these methods is to use a capitalized earnings. This is the most useful method for companies that have had stable earnings, mature companies. And when we do this method, we normalize the historical earnings. Typically at Hantzmon Wiebel, we do this by calculating a normalized EBITDA for the company over the past 4 to 6 years. Then we calculate a capitalization rate for normalized average EBITDA. This is going to be made up of things such as the risk-free. So we'll add in the risk-free rate of return. We'll look at the equity risk premium, and then we'll look at the risks that are specific to that company, as well as factoring in what we feel the sustainable growth rate of that company is into perpetuity. We will then multiply the normalized EBITDA by the multiple, and that will provide us our ending income value. All right, discounted cash flows method is primarily used with companies that are younger or volatile, where we can't expect cash flows to grow at a level constant rate. We'll have management provide projections. We might discuss how realistic those projections are, and then we discount values using the discount rate that we calculated for that company to arrive at our present value of the company. Scott, if you want to move to our. And then lastly, we look at the market approach. Again, there are two methods here. We use mergers and acquisitions most frequently because we tend to be valuing privately held companies. In this method, we use a database to source historical transactions that have happened between private companies where the data has been made available to the public. We look at multiples such as the price of the company compared to sales, or the sale price of the company divided by EBITDA, and then we'll use the company that we are valuing EBITDA or sales or discretionary earnings to calculate and use the multiple that we come up with based on other historical data to come up with a value. The guideline public company method is essentially the same in theory, but we use public companies that are being publicly traded. We use their actual values at their actual share values at the date of the valuation or the closest quarter. This allows us to look at data that's being a much larger pool of data and data that tends to avoid irregularities that might occur in the private market. When we use, the most important thing is that when we use the guideline public method to value privately held companies, we make an adjustment for the size and the fact that they're not privately held companies. But essentially, those two methods are one and the same in practice. Now we'll move on and talk a little bit about discounts that are applied and where the real tax savings is in valuation. So a typical valuation will utilize two discounts. The first discount is a discount for lack of control. This would be any interest in the company less than 51%, anything less than a true controlling value. The second discount that we see is a discount for lack of marketability. This is used to compensate for the difficulty selling closely held companies that are not traded on an open stock exchange. The marketability discount includes substantially also as well closing costs and costs to sell the company. The application of these discounts is fairly subjective. We use a number of research sources and historical data to come up with ours, but no two valuation analysts are going to come up with exactly the same value. It's an art, not a science.
Yeah, and I put the it's an art, not a science, because that's several valuation analysts that I've worked with have said that. So I figured it was important that several old guys have said it before. You know, and the marketability was explained to me previously as, and in the books as, if you can't convert that to cash within 3 days, it's less marketable. Just like I could call my stockbroker and sell stock in Microsoft within a day because it's exceptionally marketable. So moving on, these are what we need to think about and have in our mind whenever we're talking to clients or even just individuals, anyone outside the office, that indicate that they might have a potential need for valuation. You know, if they say obviously value or gift, you know, any sort of succession or planning, talking about selling, estate, you know, divorce, damages, lawsuit, with the gift and the estate and whatnot like that, that should trigger not necessarily you as knowing exactly what to do and exactly how we would do and work on up a valuation. It is purely, you know, Joe, we at Hantzmon Wiebel, we provide valuation services, and based on this conversation, you might need to have a valuation, or it would greatly benefit you, or of the like. So moving forward, the next code word is champs. Let me back up. And while y'all are writing that down, does anybody have any questions? No questions, no hands raised. Anything to add real quick, Will, before we move on to risks?
I don't think so right now.
Okay, perfect.
I'll interject if
I like it. All right. So going forward, just like any accounting or any public service that we provide, there are risks. And one thing to that we have to coach our clients up and ourselves is normally when a valuation including discounts accompanies an estate return, an examination is more likely. And that's not necessarily that we've done anything wrong or anything is incorrect. The IRS just wants to see the data that was utilized to come up with the valuation. That's been my experience in the past. And with clients that we know are going to be under the lifetime exclusion amount, evaluation will still be beneficial because it establishes the value for the estate and for the beneficiaries going forward. So that's a benefit for the clients and an extended benefit for their beneficiaries. This one's kind of a risk of, excuse me, of paying too much taxes. You know, filing a gift tax return without evaluation can result in an audit, penalties, or even paying extra tax due to an excess gift amount. And what I mean by the extra tax is just multiplying the gift percentage. Let's, for example, if you decide to give your kids 25% of your company, just multiplying your company's equity by 25% is going to show a higher gift than you actually make because of the utilization of discounts by the valuation analyst in the calculation. Some of the services that Hantzmon provides, like I mentioned earlier, exit and estate planning with value acceleration as a facet of that. Consulting, expert witness, that's less, I would say that's less Mark and Chris and more me, because I've done it, I believe, more than Mark, at least in the past. I'm not certain about Chris's level of comfort with that. It's not necessarily something that we would market substantially, but it is something that I've done quite a bit here in Texas and can do going forward. So we have a kind of a 4-person team at Hantzmon. Our core valuation team, as I guess call it, you know, Chris Brubaker, Mark Wheeler, myself, and Will. Chris, Mark, and myself are ABVs. All 4 of us are CPAs. Mark, for some reason, decided to be a CFF. Yeah, just an overachiever, I guess. One thing to note is, as of 2018, there were approximately 3,800 total ABV credential holders in the US. So it's a fairly exclusive credential. And I believe in 2018, the AICPA opened the credential up to non-CPA holders, but the work requirements to qualify for it as a non-CPA are pretty unachievable. You would almost have to only do valuations all year. So that's still difficult for a non-CPA to get it, and difficult for a CPA to get it.
Do you mind if we pop back a slide before we move forward?
Yeah, dude.
Just had a little bit to add about the valuation services that we provide. The exit and estate planning, a lot of the value that comes in from doing a valuation on your and looking forward for exit planning, Scott was getting into concerning discounts, is if you have the opportunity to meet with your tax planner and plan to give your business to your children or you know, to your children or to maybe another trusted manager, and you're trying to transition out, if you're going to be giving away or your business to somebody trying to continue it on. Having time to plan the exit and estate planning is exceptionally important. If you're a 100% business owner, you might, having 5 years to give away your business would make a vast difference in how much gift tax you would be paying on that business, because you can choose to give the business away in smaller chunks. For example, you might give 25% non-voting stock to a child, and you'll be able to take a bigger discount because of the lack of control and lack of ability to vote, and build up over the course of 5-10 years, giving away small chunks of that business without ever having to take the huge hit that giving a 100% equitable interest in a company would. Giving away 100% of the company would have significantly less discount and significantly higher tax implications. So meeting with a tax planner or an ABV not an ABV, but your tax planner to discuss the way that you might break this down allows you to take advantage of the gift planning, given that if you get a valuation done for your business when you give it away. Just wanted to add that in there while we were on those slides.
Yes, definitely, and the same thing with estate planning is the earlier that we can get in, or we as professionals can get with a client for estate planning, the better, because we can plan out getting assets out of that client's estate, so they're less apt to hit the exclusion for the estate tax. So going forward, just like everything, our services are valuable, and we bring a fair amount of value to our clients. These are the normal fee ranges for each valuation type. The top two, valuation and calculation, are the ones by far that we do the most. Oral report, at the point of paying the fee for an oral report, you may as well pay extra to actually get a paper copy of the report, because we don't provide a paper copy with an oral report because it's oral. So valuation is between $10,000 and $15,000. Calculation is between $5,000 and $7,000. The oral is between $2,000 and $4,000, and the variations in the fees largely due to the differences in the complexity of the entities that we value, and also difference in the information provided by the clients and how much extra digging we have to do and how many questions and whatnot like that. So there is some very variety in how much each level cost, but it is a valuable service that we provide the clients. All right, and the normal time that evaluation, I would say, takes to complete from start to finish is approximately 60 days. And that's from when we receive all the information along with the signed engagement letter to the report getting in the client's hand. It is approximately 60 days, and that's mostly due to getting all the information together, figuring out, like I said, it's an art and not a science, figuring out our reference for discounts, if any adjustments, discussing with the client, discussing between ourselves, and writing the report, the actual physical report, takes a fair amount of time. Any questions before we get to the last code word? No questions? Okay. So code word 3. Baylor. They're the conference champs. No, not even a smile from Will.
Not a big fan.
Well, there you go. That's fair. Like I said, we are hurting on time. Please ask us some questions. Will, do you have anything that you would add?
Let me see. What are some important things?
And like I said before, this isn't the end all be all to business valuations. We didn't want to get down into the weeds because we could have really hammered y'all with facts, and at the end of the day on a CPA conference, everybody's cross-eyed anyways. So the bulk of this was to educate y'all on what to listen for and trigger words of what you would make you think of evaluation.
Hey, Scott and Will, can y'all hear me?
Yes.
Yeah.
Hey, this is Jim. So I do have just a comment. Well, first, I think Faye put a question in the chat, so I'll let you answer that first, and then I just have a comment on.
Yeah, I see that question. I don't think that our engagement letters include that. That's mostly a just a conversation that we have with the client. No, it had the same control discount, Glenn. Glenn asked 49% and 2%. With that, you could make the case that the 49 would have the same lack of control discount as the 2%.
Right, well,
Because
yeah, that's what I was saying, that if I'm the 2% owner, it's almost like I might even have a control premium because I'm the swing vote.
yes and no. Again, this is where the art comes in. Is we usually, not usually, a lot of this depends on what the valuation is actually for, and what we're trying to achieve in the valuation. Normally with gift and estate, the higher the discount, the better, because we want the value lower, and that's based on my experience. I won't speak for Mark and Chris, but that's based on my experience. But yes, you are correct in saying that the 2% could be the swing vote, but at that point you're valuing a 2% ownership versus the 49%, which is the 49%. You could even make the case to value just a 1% ownership in that company. So it's a lot of conversations that have to be had at the very beginning and throughout the entire engagement. Will, would you agree with that?
Yeah, Glenn. So with like if it would, regardless of whether or not it was the 49, or the 2%, if it was for a estate plan, most people would make the argument that that all of those are non-control shares, and we generally go through and do a 1% valuation of the company as a whole, and then extrapolate that value to the percentage of the company. There might be some change depending on the nature of the company or knowledge of just intercompany knowledge, but generally speaking, all of those would be considered minority values pending they all have equal voting rights.
But that's a good question, Glenn.
Jim, I know you said you had a question.
Sure. I was just gonna make just to add to the conversation. First of all, I liked all the memes. Thank you. Those are entertaining. It added a nice touch to the presentation. But just thinking about some planning with a client that we've been doing. So they have a family-owned LLC that has a lot of investments in it. It had some real estate investments as well, but now it's just primarily made up of publicly traded stocks, and there is still one partnership interest in there that they're selling. So it's really going to be just mainly publicly traded stocks. And the situation is all of the grandchildren are basically adults now, and can be trusted with the money, because it was originally formed partially so that the managing member could control the assets, protect the assets since the grandchildren were young. And so they're going to be ready to, well, according to them, they didn't see much need for this LLC anymore since the kids were grown, and they were going to start the process of potentially just liquidating the company and distributing the assets, mainly stocks, to all the family members. And in part of the planning with them as well is they wanted to do some gifting. And so we were talking about it, and we said, well, but before we get rid of the LLC, why don't you do a lot of the gifting through the LLC, because of the opportunity for discounts, and this family is going to be in a taxable estate situation. And so that's just a real life example of how we are using the valuation team to accomplish a goal of tax savings. And the valuation team does a great job. The service, like you said, it's a valuable service to provide, and it's going to save a significant amount of gift and estate tax ultimately, by doing the valuation. And like you said, it's really just because these securities are wrapped in this LLC, which does have various restrictions in the operating agreement. So it does allow for a legitimate discount on the gifts. And sorry, I'm rambling on because I'm going to be close on CPE, and I need this to go long enough to get CPE.
Yeah, I understand. Thank you, Joe. Yeah.
So Helene asked, can you talk about discounts available on interest in real estate versus interest in LLCs or corporations? Is that, so when you say that discounts for real estate interest any different than ownership? Yes, potentially. With that just like Jim said, there's a different way, again, in my experience, to value a company that is a security or an investment holding company, which is utilizing several funds to get a price to net asset value percentage, basically, in real estate. And again, in my experience, real estate would have a lower price to net asset value versus securities. Yes, that's rambling. Hopefully we're trying to get Jim up to his minute mark, but let me reread the. Go ahead, Will.
Yeah. So Helene, the real estate interest versus a LLC or corporation, I think it sort of all depends on it depends on a number of things, but you wouldn't necessarily, so the real estate would only be able to be discounted in a valuation if it was held. You would be looking for, it would be important. So if the real estate is held in an LLC or a corporation, it could potentially have the same types of discounts that an interest in a LLC or corporation would have. Frequently, these marketability discounts just come from increased risk. Real estate being, at least in my experience, has always been fairly stable, particularly when it's rental properties. There's not a lot of risk that you're gonna lose out on a condo. So that's going to play a factor in it versus a LLC that's a textile company, a privately held textile company. There might be a little bit more of a marketability discount based on the risk that you'd be taking on having a small, t-shirt business as opposed to an apartment complex. But the like Jim was mentioning, the Lord, why am I blanking? Operating agreement for the LLC or corporation can play a pretty substantial role in those marketability discounts, depending on like right of first refusal for the other partners. Are there requirements that they rent or do business with another related party? Are they are there significant restrictions on the transferability of the stock? And if you had a real estate investment in an LLC and had those kind of restrictions on it, you could pretty easily end up at the same sort of discount. I don't know. I think that sounds right from my knowledge, but
Yeah, I misunderstood the initial question. The interest in real estate, I was assuming it was a company that owned the real estate, and normally we're valuing companies. And if the company holds the real estate, that's just an asset on the balance sheet. Now it would factor into the total value, but we're, as business valuation people, we're not going to outright value the real estate. It would just be factored into the value of the ownership interest of the company.
hope that helps a little bit.
Any other questions?
Charlie Beckham, Mark, and a now retired partner, completed evaluation for one of my clients, but converted from a C Corp to an S Corporation in order to calculate unrealized built-in gains. Another reason area for evaluation study for folks to keep in mind, should they have a client that converts to a C to a S?
Yes, the Baylor mascot are Bears. We'll answer the hard question.
Yeah, Mark's comment's a good one. For a company, the underlying factors are going to be of how strong the company is and how historically capable they have been of realizing returns are going to be important factors.
Yeah, that's correct. And I think we're pretty close to time.
We are. Aaron shot one more question in. Did the valuation types address in a fairly equal manner inflation, or is one more sensitive? So both. So if we were to use the income approach, we end up at some point, whether it's a DCF or a capitalized earnings method, we have to come up with a growth rate into perpetuity. And when we calculate that value, we have to consider inflation there. A company is not going. We're not expecting a company to grow if it doesn't have a growth rate over inflation. So that's where it gets considered in the income approach. So for example, we think of inflation as say 1.5% a year. We would look at the historical balance sheet and management projections, and the economic factors such as the region, like the regional volatility, and try and come up with a value that we feel the company can continue into perpetuity. So inflation is addressed in it, but it's not in that long-term calculation. But at the end of the day, the value being given is the present value, at the date of the valuation. And it considers factors down the road like inflation indirectly through the growth rate and risk, but there's no this is the discount that accounts for inflation.
Correct. It's usually rolled into, like Will said, the perpetual growth of the company. So it's not specifically mentioned or specifically utilized in a calculation. It is considered in our growth rate of the company, perpetual growth rate of the company.
Also, maybe most notably, that the asset approach is going to consider inflation the least of all the approaches, particularly if it's a liquidation. All right. Well, thank you, everybody.
Yes, thank you for your patience. And just get in touch if y'all have more questions.